Thank you. With that, Ryan?
Thank you, Ravi. So we have two great guests today. So Rachel Alexander is the Director of Research for JLL's Houston office here. She leads a team of 6 research professionals, and she tracks and analyzes key economic and market fundamentals to provide insight and predictive intelligence to owners, investors, and occupiers of commercial real estate. She has 10 years of industry experience, and she joined JLL in 2016. She went to UT, as did Ryan. So Ryan is a director in the Houston office here for capital markets. He has been involved in over $2 billion of commercial real estate transactions, previously working at Newmark. I knew Ryan at Newmark on the debt side, and he came over to JLL to do investment sales, so which I find is a unique breed of professional, given he's had capital markets experience now in investment sales. So great person to talk with. And so without further ado, I'll turn it over to Rachel. Thank you so much.
Hi everyone, this is my first meeting, so I'm excited to get to know some of you and kind of talk about Houston's larger economy, demographics. I'm using one of our technology platforms today, which is why I'm not standing. If you can't hear me, let me know. Feel free to interrupt and ask any questions. If you do, we'll kind of be moving in and out of some maps and some slides, so I'm not just boring you with kind of a lot of slide-by-slide repetition today. I'm starting kind of at a Texas view here. I understand that your speaker last month may have delved into the Texas Triangle and kind of what that means for our state a little bit, so I'll just touch on that briefly. So the 5 cities, San Antonio up I-35 to Austin, Fort Worth, Dallas, and then back down to Houston make up the Texas Triangle. There's over 21 million people in this area, which is over 70% of the state's population. Bringing that into Houston, kind of zooming in here on the map. So the 9-county metro area is over 9,400 square miles. To put it in perspective, it's larger than the state of New Jersey. So when people wonder why we have traffic or why it can take an hour and a half to get from Katy to Baytown, is because our area is so large and so diverse. And we look at what is Houston? Why do people want to work here, live here, visit here? It's for a number of different reasons. It's the arts, it's the medical district, it's the museum district, the rodeo, whether you're here to visit, stay a weekend, or whether you've lived here your entire life. These are just a few things of why people continue to visit, live, work, play, all of those different things within our thriving city. We all know this, Houston's global and diverse. We have over 7 million residents. We crossed that threshold in 2019. We're the 4th largest city in the world. You hear Houston's global and Houston's diverse, but 1 in 4 Houstonians is foreign born. We are a majority city as far as demographics, and over 145 languages are spoken here. So when you think about what is Houston, it really is so many different things. Houston is business and pleasure. So what drives kind of office demand, multi-demand, people moving here? It's the medical center, it's energy, both traditional like the Exxons and the Chevrons of the world, and then also where Houston is looking to go, like advancing energy technology, carbon capture, kind of that energy 2.0 side of it. It's the Port of Houston, it's the spaceport, it's NASA, technology, manufacturing, life sciences. Houston is a major player in so many different industries that drive the economy here locally. Kind of looking at where those points sit on the map, we have 2 international airports, of course, Bush up to the north, Hobby down south, the Med Center kind of southwest of downtown, the Port of Houston and the 25-mile ship channel and the Bayport and Barbers Cut container terminals, and then NASA down to the southeast. So some of you may be familiar with the Port of Houston. It's a large driver of our economy, not just in Texas, but also, not just in Houston, but also in Texas. It's the largest Texas port with 40% market share by tonnage. And we've actually benefited the last year or two. You may have heard about the supply chain struggles, have furniture or goods that are taking longer to ship to your house, or materials for projects that are under construction, home remodeling. So Houston's been benefiting from a lot of those ship backups at ports like, say, LA and Long Beach. We've even had increased, in addition to the population growth, and an increase in industrial users, and not just in the southeast, but we see port users kind of occupying space across the market. The Port of Houston had double-digit container growth for 10 months out of last year, and it's January and February of this year where it's highest for those respective months on record. So it continues to bring ships in loaded and unloaded, something called deadheading. Houston has the lowest rate of deadhead ships in the United States, which means they're coming in fully loaded with things like retail, finished goods, everything that you're buying at the store. And then they're exporting back out to a lot of plastics and resins, most of that going to Asia, which is the largest consumer of plastics in the world. Jumping back into the medical center has 50 million square feet of developed space. That's hospitals, nursing schools, hotels. Medical tourism is actually an industry in Houston. There's not a lot of places that can say that. People come here just for the quality of the medical care. They do over 180,000 annual surgeries, and it is the 8th largest business district in the entire United States. So a lot of our headlines about corporate relocations, a lot of more of the positive headlines you tend to see going towards Austin and Dallas, but what we really like to tout for Houston is our cost of living, because we do compete a lot more favorably than some of the other cities in the Texas Triangle. So 100 is considered the US average, so you can see Houston on the left side, we're a little over 5% below average on the cost of living. And we compete very favorably on all three of these areas right here. So housing, transportation, and grocery. Where we're coming out ahead on Dallas and Austin is on the housing side, and then New York we just put on there for comparison because you can see how much a housing would make up part of your day-to-day life, and eat up as much of your income as it does. Corporate relocations, as I said, we don't see quite as many of these as Dallas and Austin do. Our latest big names have been Hewlett-Packard, and then earlier this year, Exxon, who's always had a huge presence here, especially with their new campus in spring. They're actually moving that headquarters flag from Dallas to Houston, so we may actually see some more employment growth in that region as they kind of move through that transition over the next few years. This is kind of where all the Fortune 500 headquarters are on the map. We did overtake Dallas in 2021 for the most Fortune 5 headquarters locations. Exxon, again, was our most recent. It was Hewlett-Packard. Academy's been a long-time private employer here, but they just recently went public, which is why they debuted on the Forbes list in the last year or two. Now jumping into some of our major employment centers. So Houston is unusual in that the CBD is not the center of downtown. Most of the white-collar growth kind of flows out from the CBD westward. So we're at the Med Center, kind of down at the lighter part there at the bottom, is the 8th largest business district. The Galleria is the 15th largest business district in the U.S. So most of our office-using employment kind of flows outward west from the CBD and the Galleria out to the Energy Corridor. And then, of course, if we zoom further out, the Woodlands and Sugar Land for some of our largest employment centers in Houston. On the multi side, you may not hear about office reentry a lot, but I did want to touch on it since I mentioned the business center. So if we look at kind of pre-COVID, if most people were coming into the office, if not 100%, at least on a little bit of a hybrid schedule, you can see where we bounced. This is the US average is what we're looking at on the chart. So anytime there was a spike in cases or a new wave came on, you can see where that office occupancy kind of dipped. For me, the way the traffic is looking, it feels like everyone's back in the office. And so it surprises me that Houston's only at 55%, because it feels like there's a lot more activity in the office buildings than people are certainly out on the roadways driving and congesting like they were before COVID. But Houston, Austin, Dallas kind of switch between 1, 2, and 3 as far as people actually coming back into the office and working on a day-to-day basis. Looking at where kind of Houston's income is dispersed. Now, Ryan has heard me say this before, but I always like to point out that it kind of points in an arrow towards downtown. So our highest income areas in Houston are going to be the darker blue. They flow up towards the Heights, down towards Westview and Bel Air, and then they follow Buffalo Bayou out. This is where a lot of our C-suite decision makers live. And if you're not living in this urban core, then a lot of that income is concentrated again in the suburban areas, kind of on the western half of the metro. These trends are going to look very similar want to dip into residential growth and population growth here a little bit later on. So our population growth, over the last 5 years or so, Houston has added close to 100,000 people every year. That's usually a mix of natural migration, which is more people being born than more people passing away, and then a healthy mix of both domestic and international migration. Now with COVID, that number dropped down in 2020, I think, to 60,000, and then in 2021, our early numbers have showed us back up about 70,000, but that's kind of pulling down our long-term average, which used to be the 90 to 100,000 range. Over a third of our households make over 100,000 per year, and we're projecting another 2.5 million in population growth over the next 20 years. Kind of how that shakes out market by market. Again, you're going to see a lot of the Texas markets in the top half. Companies are coming here, residents are coming here, especially post-COVID. Some of the larger coastal markets like your San Francisco and your Los Angeles, who we never would have thought about as losing population before because they're such large, thriving metros, are seeing population losses post-COVID as people move out of the denser cities in favor of more economical cost of living, more business-friendly states. And Houston has been a benefactor of that. So you can see our growth since 2011 at 8% is higher than the Texas growth at 7.5%, and is almost 3 times higher than the U.S. growth over the last 10 years, which is good for industry, and then again, bad for our traffic congestion on the roadways. So future population growth, this is our 5-year look ahead on population growth. So the blue areas aren't necessarily negative, they're just areas that are built out, kind of where Houston started and kind of moved outward into the suburbs. And so those strongest areas for growth are kind of up through the south, in through Sugar Land, Katy, up through Cypress and a Jersey Village, where a lot of the master plan communities, housing developments, this dark patch in particular up here, that red one, is the Howard Hughes Bridgelands community. So anywhere where there's a lot of homes expected to go in is going to drive that future population growth, which also follows the Grand Parkway here, which sections have been completed over the last 10 or 20 years. And the only difference, or the largest difference between straight population projections, which are here, and then when we look at future residential growth, is you're seeing an even denser look where this next section of the Grand Parkway is underway right here, where the population growth estimates haven't quite caught up yet, but that's where there's a ton of new housing planned because they're anticipating that roadway's completion in the next few years. It's the same thing that occurred when these pieces were completed over the last few years. There were just new intersections that never existed before, that became, every corner became a retail center, gas station, following the rooftops as people moved into the suburbs. We move from kind of population and growth into employment. It's kind of a picture of a lot of the large metros in the U.S. So Houston regularly competes in the top 5 to 7, both on absolute, kind of on the left-hand side, and then percentage jobs. So we added nearly 160,000 jobs last year, which was a record for Houston. We haven't quite recouped everything that we've lost during the pandemic, but we've made fantastic headway. And you can see, New York on absolute growth up here looks very strong. We think about how large of an employment center New York is on a percentage basis, that actually puts them really, really low. Looking at the Texas markets again, very strong recovery. Each Texas market is well outpacing the United States as far as trying to recover the jobs lost during the pandemic. Now what those jobs look like is a little bit different. We've seen the kind of the office using, the white collar jobs, professional business services, a lot of your engineers, architects, lawyers, real estate. The people that are in offices every day have kind of ebbed and flowed. Where we lost the greatest percentage of jobs during the pandemic was obviously the retail and the hospitality, a lot of the industries that had to shut down and remain closed or at lower occupancies for a long period of time. But we've seen a great recovery in those over the last year or two. And then of course our industrial market, which has been thriving much like the multi-housing, and kind of getting back to talking about the port, that trade, transportation, and utilities, more industrial using demand drivers has been very strong over the last year. You can't talk about Houston without kind of getting into oil. What we like to show with this chart though is even if it feels like when we lose a lot of jobs, gain a lot of jobs, oil gets a lot of negative press in the headlines, that gray bar would have looked up and down just like the red, the price of oil, if we were looking at this chart in the 80s or the early 90s. So Houston's economy has diversified. We're still reliant, of course, on energy and the jobs and the economic impact that comes from that industry. But the gray line is much more stable, aside from the dip that we had in COVID here, compared to the volatility that's been seen in the oil markets over the last 20 or 30 years. So our peak energy employment in 2014 of 113,000, we will likely never see in Houston again. The nature of the business has changed. But our average pre-COVID employment at 80,000, we could get closer to that. We're sitting at about 65.5 right now for energy jobs in Houston. We're looking at our historical job growth and kind of looking ahead. So some of our highest periods for growth, we averaged around 70,000 jobs per year. And then in our most recent period of growth, it was closer to 65,000. So when I talked about in 2021, where we gained that 161,000 back, we lost 185 in 2020. So we're hoping with the 75,000 that's forecasted this year, we're gonna meet and then exceed and get back above our base employment level and really start to build on and gain momentum from where we were before the pandemic started. And then these are just a couple of visuals of, you'll see this one, this is bachelor's degrees, so it's really gonna follow income and where a lot of the white collar employment centers are. And then we look at STEM occupations, which are science, technology, engineering, and math, everything that might power the medical center, energy, technology, advanced manufacturing. It does look like that one's playing nice today. We'll kind of finish on population density. Or maybe we won't, maybe we'll finish on bachelor's degrees. Does anybody have any questions? Anything you'd like to know more about?
Yeah, great visuals. Thank you so much for doing that. It's quite dynamic. I like that platform. Just out of curiosity, we, obviously Houston, the core, we look at deals and it's priced pretty high. How do you see the impact, the halo effect of Houston on surrounding areas, and whether there's any areas that you would forecast as sort of underpriced right now, if you will, that may benefit from Houston's growth? I know you mentioned the corridor along 99, along northeast. Anything else, like, if you look at something like Lake Jackson, let's say further afield, or something like that, do you foresee a halo effect from Houston's growth?
On multi-housing pricing, I'd probably leave that to Ryan's expertise. I am really interested to see, as you mentioned, kind of how that growth actually, we look at forecasts, but sometimes our forecasts aren't right, or sometimes they're even more exponential than we realize. So if that, as the roadways complete on the northeast side, if it has the same impact as it did on the northwest side of town, because the northwest side, think about Katy, Cypress, Jersey Village, those have always been very densely concentrated with population and homes. The northeast side tends to be more industrial and it's a little more open land. So it's going to be a very interesting story of Houston to see if we can have the same success realized as that roadway continues to complete around town. But we're continuing to see what defines Houston and what is suburban just continue to grow and push those boundaries. So some of the constraints that a market like New Jersey or LA Long Beach have, we don't, because we're not land constrained. We don't have zoning generally. And so there's some opportunities afforded here that are actually challenges in some of the other markets that we compete with for talent and for business.
In terms of pricing, the prices typically follow rent growth, right? And that rent growth comes in from an imbalance of supply and demand. So, Richard kind of touched on the demand side of where these people are moving to, where there's going to be income, where there's going to be money to be spent on rents. And I got a section in my slide deck that I'll kind of touch on the supply, what we see coming up here in Houston in the next 2 to 3 years, and kind of where that supply is delivering. So it'll be important to know kind of what pockets of town are going to be oversupplied. There might be good buying opportunities there for a little bit. It's kind of nice to buy a deal when you have concessions in a rent roll with T12, because then over the course of 2 to 3 years, you kind of flush those out, get your NOI up, and then sell it at the top. That's the goal, right? So touch on that. That's a good question.
The Greater Houston population is about 7.2 million right now.
Mm-hmm.
And what do you expect in next 10 years? And which side do you expect it to grow? More?
This isn't current, so this is our 5-year look ahead. So where we see the yellow and the orange and red are the areas where we think it's going to be the strongest. And surprisingly, an area like East Downtown, 10 or 20 years ago, you wouldn't think about the population growing there. But that's an area that has very much changed and diversified and grown as the sports teams have moved over, as it's become a trendier area. So those are areas that in Houston's history, you may not have seen pockets there. And then these rings just continue to move further and further outwards as these amenitized communities continue to grow. It's where the stronger school districts exist. And I think the 20-year growth is 2.5 million people. So it's about 1.5% a year is what we average. And so that's where our line is, kind of between the blue and the yellow. So the blue is looking at kind of under 1.5% a year. And then the yellow to orange to red kind of tiers upward after that.
Regarding I think we got a bar chart showing population growth, or where people were moving, right? I was curious, yes, that one. Do you have data that you could put over this that would show the income, the income that this population is making, or are we gaining
Right, what
blue
types of
collar
people?
workers, or I think the perception here, at least what you hear in the press, is that everybody from California is moving to Texas, right? So I think the people would kind of perceive that to be higher income demographics. I'm just curious if that's really what the numbers show.
That's a great question. That's, I think, something we need to look a little harder at, because we're seeing where our office on the commercial side is struggling. We're seeing incredible demand in industrial, but that could be warehouse distribution labor. We're seeing tremendous growth in multi-housing, but what kind of people are moving here? I think that's something we do need to take a closer look at. That's a great question.
I thought the slide on the job distribution showed more of a higher paying jobs that we're gaining. Isn't that a slide you showed?
Yes, I think this one.
Yeah, so that's trade, transportation, utilities. Those are going to be higher
Like
paying
advanced
jobs
manufacturing, maybe.
related to industrial.
And this varies greatly. So this is a 12-month look back. So when we did this, a couple months ago, the professional and business services tier had actually gained the most over the previous 12 months.
Yeah.
So it's a moving indicator, and it kind of changes as these industries move through different points of recovery post-COVID. But we've seen record construction, leasing activity, absorption on the industrial side, and a lot of, just like the migration of people from California, we've seen a lot of migration of companies as well. And some of that's related to port congestion, and some of it's related to cost of living. But it's both people, business, and industry. And there are a variety of industries coming on that side.
All right, why don't we let Ryan do his portion, and then we'll do a big Q&A at the end. That way we make sure we get him in the door,
Yeah.
and go from there. Thank you, Richard.
Thank you so much, Richard.
So this is going to be largely kind of conversational. I don't have as much slides as Rachel. I think I got 11 or 12 up here, so feel free to stop me, ask questions if y'all see something that's not right or y'all thought about. Feel free to interject. So this slide right here shows kind of the tightening labor market and kind of how the supply in Houston follows employment. I'm going to touch on this here in a bit, but you can see kind of in Houston, it's hard to see that little thin gray line, but over here way to the side, our gross metro product followed kind of the booms we had in the oil and gas industry. So when we had kind of oils running up in 2013, 14, 15, we saw a ton of employment. And the developers here in Houston, with no zoning, not a lot of restrictions, really friendly development environment. So they flipped on the switch. They started building a ton of units, and so we'll get into that here in a bit. Just an interesting thought that I saw on this comment is that, on this slide rather, is that you can see that the product in Houston kind of tails off from the national and Texas average. here at the end of this left graph, although the employment growth kind of slumped a little bit. Just thought maybe a good buying opportunity coming up in the future. If we have a market that's oversupplied, that means values may drop a little bit.
When you say product growth, you're talking about multifamily, is it?
Correct.
So-
Yeah,
okay,
this
got it.
is all multifamily specific here.
Got it.
That's right. So here, this is kind of just more of the same. Ton of Fortune 500 companies, strong employment growth. I think having a combination, as Rachel mentioned earlier, of being an affordable city compared to most, and also having extreme diversity in our citizens, really kind of puts Houston on the map for a lot of these bigger REITs and institutions who are trying to fill these ESG buckets. And for y'all who don't know what ESG is, it's kind of a qualification of investment for environmental, social, and governance. So it kind of Houston checks a lot of those boxes, kind of those bigger REITs and institutions who are looking to invest capital across the capital stack, across the nation. Houston's one that was kind of off of their radar a long time because we were pretty heavy in oil and gas in the 80s and 90s, but now that we're a little more diversified, it's back on everyone's radar. We're getting calls, from all the big Blackstones and all the big companies looking to invest here. So this shows kind of the in-migration population growth. You can notice here on this left kind of bar chart that we have the net migration kind of in the light gray, and then the natural increase. This is just, babies born over deaths, kind of the delta there. It makes sense in 2021 that we have a lot of babies being born. I know my wife and I were victims to the COVID baby. We just had a kid a couple months ago. But no, I'm interested to see how 2022 comes out too. I'm really curious to see those numbers because people are still kind of staying indoors, but it kind of follows expectations there, I think, of having a lot of babies during COVID. But as you can see, Houston has had really strong population growth over the last decade, well above the Texas average. We kind of dipped a little bit after we kind of had the commodity crisis in 17, 18, 19. We saw a little bit of employment growth. People didn't really move here as much, but we're again kind of regaining that traction, being north of the Texas average.
These gray bars right here are as high as they are because that's when oil prices were $100 or $120 a barrel, and there was a lot of investment and employment coming in from outside the U.S.
There's a lot of information on the slide. I don't love this slide. I don't like to talk about it. It's better just to read this one and get back through your notes. Some kind of key points I want to point out, which will flow over in the next slide, is that right here we had 36,000 units of absorption in the trailing 12 months. Typically, Houston absorbs about 15,000 on average, and over the last 12 months, it just exploded. We saw a bunch of population growth in the city over 2020 and 2021. With an average of 36,000 being absorbed, only 2,600 being delivered. It was a pretty big year in rent growth for Houston. I think we averaged 15 to 16% rent growth across the city, which generally Houston averages 3 to 4%. So last year was certainly an anomaly for us in rent growth.
Do you know where that mainly is? Where they're building?
Where the construction is or the absorption?
The construction.
Right now, a lot of the pipeline that's going to be delivered in 23 and 24 are kind of in 3 submarkets. It's out in Katy, up kind of Spring and the Woodlands up north, and then actually, believe it or not, kind of Midtown Med Center is where all that kind of supply is coming online. I think 65 to 70% of the units that are delivered from 23 to 24 are in those 3 buckets.
What about what Rachel was talking about, the Grand Parkway? Do you see applications starting to anything there?
Yeah, we do. It's a little early for multi. I think multi kind of follows single family in some regard.
Got it.
So not a ton out up there in the Northeast quite yet, but definitely a box to keep your eye on.
And Ryan, so we had CoStar talking about the absorption, and Rachel, feel free to chime in here, but she seemed to indicate a lot of that was people moving out of their parents' homes, finally as COVID kind of lifted. So what do you think that is going forward? Because that is very strong, right? It's like a 3 to 1 delta versus construction. But what does that look like going forward? Does that change the supply-demand balance?
So, this is a good soundbite. We heard this from multiple property managers. We heard of the COVID divorce. Couples getting split up during COVID, or even like a roommate situation if you're sharing a 2-bedroom, one 2-bedroom unit, there's people splitting and going into one bedroom units and kind of spreading out from that regard. So, I wish I had a crystal ball and I could tell you what's going to happen going forward, but we still see pretty strong absorption during the first few months of this year. We had Bruce McClung in our office this week for our Department of Data Services, And they're in my opinion, the best third-party data provider for multifamily in Houston, localized here in Houston versus a Houstonian. And he thinks it's going to be pretty strong again this year. Probably not what we saw last year. Last year was pretty nuts, but in terms of absorption, we're seeing pretty good stats so far.
On the office side, when we had that graph of kind of return to work, where Houston may have started at 95 or 100%, and we're excited at this point 2 years back to be at 55%, that number's never going to get back to 100%. People are going to be doing hybrid work, working from home. That element that changed during COVID is never going to get back to the way it was pre-COVID. And so those people that built out the home offices or wanted extra spaces because they're now home 2 or 3 days a week versus being in an office environment, they're going to continue to need those spaces. So to Ryan's point, it may not be at the same rate, but that demand is not going to evaporate because the work culture and where people are working from and what they want that environment to look like is some of that's going to stay, and it's going to be at their homes.
You extrapolate that into multifamily, so does that mean one-bedroom apartments are now not going to be needed because everybody's going to have a separate office from home? Is that going to drive makeup of?
Yeah, we've seen a really big attraction towards larger one beds with maybe like a side den or a side workstation, garage products. If you have attached garages in your multifamily product, we're seeing a big premium for those in the market currently. And then townhomes, a lot of these multifamily developers are now starting to build townhomes in the back, or if they have like a little awkward tract they can't go vertical on, they'll build townhome units. And those have been very popular just because, again, people are trying to kind of get that work-life balance figured out right now after COVID.
And a millennial moving out of mom and dad's house is still that's an upgrade for them to have their own space, but still be a one-bedroom apartment. So that demand segment doesn't just evaporate by any means.
Again, this is kind of more of the same. You can see here the imbalance. We should have labeled these series, I apologize for that. But the light gray bars are units being delivered online, and the dark gray bar is the units being absorbed. So you can see the imbalance we had in 2021. That's why we had 16% rate growth, because there's that super high absorption with really no product coming online. But with that said, developers in Houston are so active, and they can wreck a market or other sub-market in 24 months. And so right now we're seeing some pretty strong deliveries for the back end in 23 and 2024 for multifamily deliveries.
And what those deliveries? There's different classes of deliveries too, right? Are they like top end, class A, high amenities? Are they more sort of workforce? What are they targeting?
That's a great question. I think we've got that in our next slide.
Okay, that's why it's a good question.
That's right. Yeah, not this slide. It's definitely the next one. But this is the transaction volume. So you'll know from a brokerage perspective what we see happening in the market. Typically in Houston, and that 13.5 is really like a 14.5. There's a bunch of off-market trades that don't get reported. But we generally see a market that's around 6 to 7 billion in transactions, and last year it was about 15, and so it was pretty insane. And that's kind of flown into this year. We see that volume not reaching 2021, but it'll probably get up to 10 billion this year, if I had to guess. We got some headwinds coming though, but.
You mind going back to the last slide, please? Thank you.
Will you be able to share these slides by the way at the end?
Probably not.
Well then. Get those photos.
That's a good one there, that last one.
So you can see the type of product that's going to be delivered, right? This is going to be our suburban pipeline in the dark red, and the urban pipeline in the light red. Currently what's under construction, it's heavily outweighed suburban to urban, and what's proposed is, again, heavily suburban. I think right now we're seeing a lot of the urban supply that came on kind of 19 and 20 be absorbed, and rents have decreased and softened a little bit in the urban, but going forward we see some pretty good buying opportunities in urban markets because there isn't that supply coming online. During COVID we had this big kind of migration out to the suburbs because everyone kind of wanted to get out of the dense city and more space, and we've seen that come back into Houston a little bit, and that migration inward is syncing up with a lower supply delivery of urban products. So we think it's going to be a pretty good recipe for some urban rent growth. So this is just more projected rent growth. You can see we're still positive, but you can see kind of the anomaly of 2021, what really happened there, and kind of imbalance of norm.
So these are your forecasts, right? Or that's
the gray is historical. These red are forecasted. That's correct. And these are all as of April of each year. So this is live data that we're looking at for 2022.
that's inclusive of all property classes?
Correct. Correct.
So 7 and 9% rent growth is not real, right?
You know, Houston is so submarket specific that in a given submarket, like absolutely, we'll see 12 and 15 in some submarkets this year, and we'll see 2 and 3 in others. So it's hard, you can't just paint Houston with a broad brush because I'm even scared to say it's submarket specific because it's so neighborhood focused. As you know, you drive around across the street and you're in a whole different demographics, but these third-party data providers might clump it all together as the same submarket. So it's hard to kind of.
Question.
Yeah, what's up?
Can you talk a little bit more about the reasoning on in year 2024 and 25 it seems to be decreasing, why that is?
Yeah, so that's the supply pipeline. A lot of units are under construction or proposed right now that are planned to be delivered kind of in the middle to back end of 2024. And generally when you see a bunch of supply kind of enter the market, you'll see rents depressed a little bit. So this is just kind of, some predictions that we had, and we hate to do predictions as brokers, it never turns out well for us. But I mean, it's more the same, right? Like, I think right here is really the big one, is that urban buying, is that we think rents are set to pop because there's really not a ton of supply coming in the urban Houston right now. And again, with that migration inward, we think it's going to be pretty good. But we can go through some of these. Transaction volume won't be as robust as 2021. It'll keep a similar pace. Yield expectations will hold firm, which that is probably a little outdated at this point. I think the next slide is going to show us that we have some headwinds coming, which we'll talk about here in a second. But new supply in the suburbs, we see that coming. It's 2022 is going to be a good year of urban rent growth. It's kind of our theme as a company, as a team for 2022.
Can you talk about the PFC sales?
Yeah. So raise your hand if you know what a PFC is, or if you know what a PFC. It's called a publicly funded corporation. So what it is, it's a public-private partnership with the Houston Housing Authority. And what's happening right now, and it's kind of up in the air whether or not we'll be able to get these deals executed going forward. But effectively, what happens is that the Houston Housing Authority comes into an asset and they buy the land, and they give the operator, being Life Changing Capital, a ground lease for 99 years at $1 a year. Give it to them for free, but they also have a partnership with them. And so what happens is, in return, this is a way to kind of push through affordable housing through Houston, is that in return, the operator has to designate 50 to 60% of their units to being affordable units to qualify for 60% or 80% of the AMI. However it's structured, it kind of differs deal by deal. And in return, the operator pays no property taxes. So you have $0 in the property taxes. But what you can't do is increase your rents up above market, so you're kind of capped on the rent side. So it's a way of the city incentivizing kind of the private-public partnerships to, organically make affordable housing. And in return, there's a big tax benefit. But it's a little controversial right now. The school board's really pissed off because the school boards generally will get that tax revenue, and right now they're not getting it. And so they're like, what the heck's happening? You're sending more kids to my school, but I'm not getting taxes for your apartment building. So it's in contention right now, but that has been kind of a trend that we've seen over the last 12 months here in the city.
Both for new development and acquisition for existing?
The PFC structure is for new acquisitions, and I don't think they'll do a development deal, from what I'm aware of. Yeah.
Would you say 50 to 60% of units, like you just mentioned, is that pretty typical? I've seen it more like.
It started out as 40,
okay,
and then the city kind of decided they're giving away too much at 40, so they moved it to 50, moved it to 60, and they kind of weight that based on location and incomes and the price of rent.
Yeah, you mentioned a good point about school boards. I'm curious if you've already parsed through the fact that school boards now will be limited to no more than 2% increase in tax revenue going forward. This is a brand new mandate across Texas, and then they'll have to go to the voters to get any more than 2%. How does that play into any of these?
Are you talking about their millage rate that they're allowed to charge?
No, beyond millage. No, millage. That was the irony of the millage. Millage made no, because you can
There's
always
no dent in it, right?
increase
Yeah.
the taxable basis.
Right.
What we're saying now is 2% tax revenue. Period.
Interesting.
So
Yeah.
no more. how does that play into some of these forecasts? Because they're gonna have to, many of these school districts are gonna have to go to the voters to get more money.
Yeah, interesting. You know, we haven't really played that into our numbers or anything like that, but it's a good comment.
I had that conversation with Fort Bend
Yeah,
specifically about this, yes.
interesting. And so here, this is kind of the last slide. One of the kind of big headwinds we're seeing really in the last 30 to 45 days. This is the forward-looking SOFR curve from April 2022 on the black line and February 2022. So what this is effectively is this is the expectation of risk in the market, right? This is the expectation going forward of what the SOFR pricing will be. And this is secured overnight financing rate for y'all who don't know what that is. It's the bank's cost of capital, right? So your lenders who are charging interest
For those who
rates.
might not know, it's the LIBOR replacement essentially.
It's a
right?
replacement for
So-
LIBOR,
yeah.
exactly. And so all these lenders who are giving y'all interest rates, they have a cost of capital on their back end, and that's what this is. So when their cost of capital goes up on the back end, that means the down end user's interest rate will increase. And so the expectation in February was that it's going to kind of taper off at 2%, and then Russia happened, continued inflation happened, and the Federal Open Markets Committee and Jerome Powell have kind of taken the stance to rise interest rates to get this inflation under control. So now the perspective has changed, and we believe that interest rates we know that interest rates have been rising over the last, call it 60 days. What used to be on a bridge term, 75% of cost at 3.25 over LIBOR or SOFR is now probably cost you 375 over SOFR. So that it's a material change. And Ryan can tell you, and I was talking to Max, who's at a lender before we started, and he said it's we're looking at pricing changes almost daily now. So it's something that's we're watching, we're very aware of. I think as a salesman, it helps me having a kind of debt background and having a really good capital markets platform here at JLL, because we are always talking about this every single day, tag teaming it to make sure we have qualified buyers buying our deals, we're vetting their underwriting. So something, if y'all are out there purchasing multifamily, I'd make sure that you're really in front of your lenders hard. And if you hire a debt broker, make sure you ask them every day, is my quote changed, is my quote changed, because they're shifting on us right now pretty quickly.
So will that finally get cap rates to reverse?
So we haven't seen that yet in Houston.
What is it gonna take?
So yeah, so two positives for Houston right now is that we still have positive rent growth, and we still have a really strong demand of buyers. But rising rates are real, and if one of those two kind of beneficiaries to us disappears, if our rental rates kind of start tapering off or buyer demand slows, then we'll see an adjustment. We had our national multifamily call last Friday, which is my team and all the teams around the entire country for JLL get on the call and talk for an hour and a half, and talk about just recent trends they've seen. And it was Denver, it was the Carolinas, and it was Florida. These markets that are really priced to perfection, have really thin yield. They've seen about a 20 to 50 jump in cap rates over the last 30 days.
20 to 50 basis
20 to 50 basis points jump in cap rates. So what used to trade at 3.5 cap now probably trades in those markets at like 375 to a 4 cap. And that's solely because of the cost of capital from the buyers. So we haven't felt it in Houston yet, but again, it's like if we see rents start to taper off a little bit and those rates to continue to run, there's going to have to be an adjustment, because you can't no longer buy 3.5 cap at 3.25 interest rates, because if those interest rates go up to 4%, the cap rate's going to have to move up more than that just to make some yield.
Do you have any visibility as to folks that the deal only works because it's interest only, low rates, floating rates, right? And rates go up. Do you have any visibility as to potential for distress maybe a year from now? Any comment on that?
Yeah, I mean, the best visibility we can do is to kind of look at those supply projections and kind of guesstimate what rents are going to be. Look at the third-party data, because those guys are smart. They do it for a living on those projections. That's kind of their staple. But no, I mean, weigh in those rental increases versus the rising cost of capital, and run that through your models. Run those forward curves through your models when you do it, because it's very real.
How many people do you think actually run those forward curves through their models versus just because what I see when I see deal decks come out from other syndicators, is they're like, oh, this is a 3.85% rate, and I'm like, no, it's not. It's SOFR plus probably 4 now, and when you look at SOFR a year from now, and that's 3%. That's a very different economics, right?
Yeah, that's right. I mean, I would say probably 50% of our buyers actually run forward curves. Out of those 50%, probably 80% of them are like institutional or private equity. So in terms of syndicators, if y'all aren't investing with Ryan, y'all should be, because he thinks about this stuff because it's very important. But no, I mean, the syndication world, it's just a handful of you guys that actually can foresee those forward curves and actually underwrite them. But I mean, it's the responsible thing to do, I think, at a time like this. Totally.
So on that note, the way property taxes are going up here,
Yep.
it's like the property, like it was 15,000 in the tax, right? Suddenly yesterday they came out in Galveston 45,000. So now what happens is insurances are going up, property taxes are going up.
That's right.
The people who own the property, then they're paying rates, whatever is there. They got to raise rents in order to meet meet their expenses or do whatever it is. Of course, it will depend on the supply and demand. You can only charge as much as market will pay. But then, end of the day, then something will happen.
Something's got to give, right?
Something is going to give.
Yeah, and you hope that your tenants are starting to get paid more from their jobs. Like, we hope that
which
wages
is
continue to go up.
which is probably not likely to happen. I mean, a lot more in considering, what is there.
Yeah, and we see it happening. Walmart just announced that they're going to pay their truck drivers a lot more. And,
Right,
and
right.
CVS came out, I think it was 3 or 4 months ago, saying that they're increasing their salaries by 15%. And so we see companies reacting, but to your point, like, you're right, taxes are going up in the county. Insurance costs are rising, especially here in Houston.
It's a lot.
Even for non-flooded zones, now we're seeing $725 a unit, $750 a unit for deals that are dry and out of a flood zone, which
$1,000
2
a
years
unit.
ago was probably $350.
You're looking at $1,000 a unit for insurance in Texas City area.
Sure, exactly, yeah.
And go ahead and overlay security costs as well on top of that with crime. So that's another added cost. I know that you guys do underwrite a lot of deals, and when you're looking at these various MSAs. So you're saying cap rates are going to stay in the 3.5 range or what have you. So can you tell me where are deals trading at as far as deal or opportunity in terms of IRR?
IRRs, yeah.
You compare all these markets, North Carolina, this, that,
Sure.
Carolina. Can you tell me where are deals done IRR wise? So instead of talking 3.5% cap, just tell me, there's deals been done in Houston when it's 7 IRR?
Yeah, so I'll start with the very different depending on class type. I'll start with the Class A. Class A multifamily in Denver probably trades from like a 9 to 13 right now, depending on the location. In the Carolinas, it's probably in that same range. In Florida, it's probably a little tighter in Florida, I'd guess. I'd probably say the average is about 10 to 11. Dallas IRRs for Class A are, again, probably low teens, maybe 10 or 11%. Here in Houston, we see probably 12 to 14%. There's a little bit of premium for Houston in the Class A side. And then on the Class B and C side, add 5 points to those ranges. Those ranges kind of stay the same, but I think what we're seeing here in Houston is the IRRs probably 16, 17% on the high end. And I think the aggressive underwriters are kind of underwriting 18%, 19%. And those are the guys that are winning deals nowadays, but as we see this environment become a little more rocky, I think some of those kind of syndicator cowboys who are throwing money at deals are going to get flushed out a little bit because they're going to get a wake-up call when they get that new debt pool come around.
Yeah, I think the aggressive underwriters are not getting 16, 17. They're going the other way on the IRR.
Well, they're getting pushed down. I mean, it's been very challenging. If anybody's tried to buy an apartment building in the last 12 months in Houston, there's some real competition out there. So those yields expectations are decreasing. That's right.
Thanks.
Yeah. What's up?
Have you seen any kind of any analysis that's done on the cost of debt as it increases and how that'll affect the cap rates to kind of see at what point will the return expectations come down? Or
Yeah.
Kind of a break even?
Yeah, it's a good question. So we run a scenario analysis for all of our properties. And effectively run the underwriting based on our initial stage and then go up and increase the interest rate by 25 bips just in sections and decrease the leverage a little bit and see kind of what happens there. But again, right now the rising cost of capital is offset by rental increase and strong buyer demand. So at those properties that you see trading, we haven't seen really a change in cap rates yet or a change in price.
Yeah, there's multiple toggles, but I wonder if that does level off on the rental increases. The cost of debt is expected to continue to go up.
Yeah, I mean, if your debt's more expensive, then your cash is going to be lower. All else equal.
So do you see, historically we've had some correlation between 10-year and cap rates. Do you think that, there was an article I read that was like, cap rates are going to, continue to compress, even if 10 years go up. And I'm like, it just can't, it's not possible.
Yeah.
I'm curious, you know, what you think.
So the argument is kind of, it's interest rates versus capital flows, right? The cost of capital versus how much money is trying to buy the product. And right now, there's such a strong demand for multifamily. Like we just ran a process at the Ranch of Champions, property up at 249 in 1960, where we had 24 offers, you know, which typically a process gets you about a dozen. We had 23 offers in. Half of those were above our whisper pricing. But what we didn't see at Ranch of Champions was that emotional bidder, we call it emotional pricing, that emotional cowboy, what we call it, just kind of throwing money out, trying to get a deal done.
That's
That's a
happening in
dynamic.
single family.
That's a dynamic that's changing, I think, because people can't rely on their debt quotes at this period in time, and so they're less likely to go attack a deal like they were 3 or 4 months ago.
It's helpful.
Single family homes are seeing like 100,000 more people offering
Yeah.
Yeah.
than asking price. One of my friends just bought, home was like listed at 750, he paid 870.
Yeah, that's right.
And like he said, but like put it in the market, it came in the market today, 2 o'clock, sent the offer in the night and said, if you want it by noon, confirm.
I think that's a side effect of where people are coming in from. They don't
Right.
bat an eye. Somebody coming
That's
from
correct.
San Francisco at a 400,000
Right.
versus a 500,000 when they're coming from having to pay $1 million to live in the city.
It's more in the range of like the 800 and 700 and plus. Not so much on 400,000, but more in 700,000 plus.
Interesting. Yeah.
And which is California and New York people, a lot of
That's right.
coming.
I'll be interested to see how our cost of living, you know, because it's kind of a backward looking when we talk about it, but how that kind of changes over the next 12 to 24 months as that kind of inward migration picks back up and we're getting a lot more from those expensive coastal markets.
And again, that's like a supply demand equation, right? And even so, in the multifamily acquisition space, it's how many properties are available in Houston to buy, and how many buyers are out there trying to go get them. You know, and right now, there's a really strong demand for it, so we see prices kind of staying flat as is, but as we've all talked about, expenses are going up. So it's a question of how much can our revenue go up alongside that.
Supply is low. Hundreds of people are looking for deals, and supply is very low.
That's right.
Comparatively. At least at the right price.
That's right. Yeah, exactly. That's always the question.
Justin, you have a question?
Yeah, I was going to comment along with interest rates. We just went through the interest rate cap.
That's right.
Cap is crazy. We
Nuts.
just paid 170. We had a 1 week delay in closing, and our interest rate cap went from 130 to 170 on a 5.5 unit level.
That's right.
If we bought it 3 months ago, that same cap would have been $30,000.
So what we're seeing now is a lot of borrowers weighing the cost of 5-year fixed rate options because you avoid buying a really expensive floating rate cap. You know, I mean, I've heard of quotes, you know, on a $30 million deal, getting quoted $500,000 just for interest rate cap, or even more in some regards. So we have seen buyers kind of looking at the bank quotes, 5 years fixed, 5 years IO. It's going to cost you probably 5%, but your exit options are still pretty flexible on those short-term fixed products. And because of the cost of those caps, it's looking kind of attractive in some scenarios.
Yeah, when we went back, we're like, we would have been better off doing a fixed rate.
That's right. Yeah.
I could have paid 1% more and it would have been cheaper to do that.
It is, and then the trick with those fixed rate loans is flexibility, right? You got to be able to get out of them. Because if you're stuck with a fixed rate loan, you can only exit in like one little year at the end of it. Then it's almost like you're just trying to time the market with your investment strategy. So having that flexibility when you're looking at those fixed rate strategies is really important way.
One more question. So you guys were talking about the office market. Was that if there's 5 tenants in a building, because you were saying percentages, this is how many tenants came out, or this is how much of their office space came out?
How much of the physical the employees are back in the office?
How do you get that data?
It's by badge swipes coming in and out of buildings, in and out of garages, and in and out of tenant suites.
Do we pay for that, or is that public?
Some of it's public, and then you can pay for another element of it.
So it's only based mostly by like Class A, Class B office space, right?
Yes.
Still good positive office activity. In West Houston, we were talking this Monday with our whole team, and there's I think 350,000 square foot of leases that are about to be executed in West Houston, which is kind of a good positive sign for Houston office, because there hasn't been a whole lot of talk about Houston office the last 5 or 6 years. I don't know. I don't know the answer to that. Neil.
So we are faced with a almost $500,000 of interest rate cap
Yep.
right now.
Yep.
What can you suggest to bring it down? Can we try negotiating, increasing the strike rate
Yep,
or,
so
or
you-
a springing?
So your two levers are your strike rate
Mhm.
and the duration,
Right.
right? The amount of time that you have that cap in place versus when does that cap actually go into effect. So increasing the strike rate will make it cheaper for you. And if you can get that duration adjusted, you should be able to see some alleviation there. But again, like lenders typically have pretty hard parameters on that because then I'm assuming you're getting a bridge loan.
Right.
They're then taking that bridge loan and going and securitizing that into a CLO. And when they securitize it to a CLO, those CLO pools have parameters on those caps. And so you always want to ask the question, because if you're not going to ask it, you're not going to get it.
Okay.
Right? But those are the two levers, is the strike price and the duration of the cap.
And duration, can they split it out to just buy 1 year at a time instead of buying the whole thing together?
Yeah, they can. I don't know if they will. They can. It's a good thought.
All right, guys. It's 1 o'clock, so we always try to respect people's schedules. I'm sure you will be hanging out for a bit.
Yeah.
Any questions or
We
whatever?
will.
But thank you so much, Rachel and Ryan. Really appreciated those insights on Houston.
Thank you, guys.
Anything you want to add?
No, thank you again for everybody for coming, Ryan and Rachel. Thank you.